Ever wondered how Delta-Hedged options can keep things steady, even when stocks are all over the place? Let's find out. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. How do Delta-Hedged options eliminate stock predictability? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. To sum it up, someone's going through a paper on volatility surfaces and expected option returns. They hit a line about predictability from the stock itself and wonder if that idea is just for academic research or if it should impact real-world studies too. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. According to one reply, the return of an unhedged option mainly depends on the stock's price movement. By using Delta-Hedged positions, traders can focus on option-specific behaviors without worrying about stock price changes. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Alright, now that we've seen what the community had to say, here's our take on this question. Delta hedging is a handy tool for managing risk by balancing out stock movements. For instance, if someone holds a call option, they might short some of the underlying stock to even things out. This strategy lets traders focus on option-specific factors, like volatility, and is perfect for those looking for steady returns without betting on which way the stock will move. In this video, we've covered how Delta hedging can neutralize the impact of stock price movements on option returns. This strategy lets traders concentrate on option-specific factors, like volatility, to manage risk without betting on stock direction. It helps isolate and analyze how non-stock factors affect option returns. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.